talking to Gary Roloff, who is both the CEO and founder of Buy Now, Pay Later company Laybuy. It's listed on the ASX under the code LBY. Now, Gary, we think there's a misconception in the market that there's too many competitors in the Buy Now, Pay Later space. But the participation rate of users of Buy Now, Pay Later is still relatively small, particularly in the UK. Our research suggests that there's only a 1% adoption in the UK. Now, that is a key market and a key focus for Laybuy, and your numbers from Q2 suggest that there is still significant growth to be delivered on by Laybuy. So can you talk to your Q2 results and talk about the growth metrics that you saw in that quarter?
Yeah, sure, Tim, and thanks again for having me on Share Cafe. Look, our UK business continues to deliver for us with significant growth over there, particularly in Q2, where we were up 93% year on year. And if you remember when we spoke at the end of our financial year, we're up 500% year on year for the March 31 year. So, that growth trajectory continues for us, and that is our growth engine. That said, ANZ continues to produce great numbers as well. So the business is growing and continues to grow at a pace, and our focus remains in those three territories.
Online shopping has really accelerated during COVID, and apparently that was especially the case in the UK. How much of a benefit has that been for Laybuy, and what will happen to the penetration of online shopping now countries are opening up again?
Yeah, great question. Look, I think all online businesses have clearly benefited, dare I say it, from the global pandemic that is COVID. And we are one of those players in that market, and certainly we have seen the shift to online shopping benefit Laybuy. Interestingly, since the UK has come out of lockdown, because you'll recall that they have been out of lockdown most of summer, we haven't seen any shortfall in our growth at all. In fact, it's continued to escalate. That is as much to do with the fact we've brought on so many new merchants, including the likes of Amazon, ASOS, Nike, Adidas, Marks and Spencer, etc. But also our in-store tap-to-pay solution is gaining more traction in the UK as they start to open up and shoppers are heading back into store.
Gary, your numbers suggest you had significant growth from your affiliate marketing program. That's something Laybuy has recently joined. What exactly is that? How does it work? And what sort of benefits does it bring to Laybuy?
Yeah, look, the affiliate marketing program is, we tend to call it non-direct as opposed to direct integration. So the direct integration is obvious. We are integrated into the checkout of a retailer. The non-direct is via a combination of software partnerships with EML and Filler. And that allows our customers to shop at these retailers like ASOS and Amazon and eBay and others. When they shop through our app, we actually inject Laybuy into the checkout of those retailers via a one-time use digital card, and the customer can shop and pay by Laybuy with those brands. So very simple, very easy process for the consumer. And obviously the benefit to us is we open up these massive brands to our database of customers, and we're attracting new customers because of those new brands as well.
Gary, at your Q2 results, you also announced a new debt facility. Can you explain to those who don't understand the Buy Now, Pay Later space how an efficient capital model is a clear advantage for someone like Laybuy?
We actually announced an increase in our existing Kiwibank facility to 30 million New Zealand dollars. Kiwibank supports our debtor ledger for the ANZ market, and a new facility via Partners for Growth, a US-based specialist lender with obviously offices in Sydney who we dealt with, and that's for £30 million. The thing that makes that so attractive for Laybuy is that we actually spin our capital almost 25 times a year. We are the most efficient Buy Now, Pay Later provider in the market because of our weekly payment cycle. And interestingly, our average duration is 2.5 weeks. So we have a lot of people that pay early, and as a consequence, we spin our capital fast. So we get a great wind out of our facilities because our capital is turning so quickly. To put that into context, a £30 million facility fully drawn, has the ability to support a £600 million GMV, because you just basically multiply the facility by 20 for ease of maths. So that's how it works for us.
And Gary, with the current trends, are you expected to reach your targets by year end?
Tim, look, our October has seen us eclipse 900,000 active consumers, and we're continuing to add those obviously daily. We're through 12,000 active merchants, and we've exceeded 3,000 active merchants in the UK alone. So the trajectory is right for us, and we are still on track to achieve that goal that we set ourselves of $1 billion in GMV for FY22. So I'm really looking forward to this next 3 months to see exactly what we can achieve. October's stacking up really well, and it's onwards and upwards from here. It's an exciting time.